Welcome to Talk Tickers. Today we're breaking down Matson's Q2 2025 earnings call. And let me tell you, this one was interesting. On the surface, it looked like a massive beat. But once you dig in, you'll see it hides a much more complicated story.
Okay, let's just jump right into the big number that got everyone talking. Matson posted GAAP earnings per share of $2.92. Now, analysts were expecting something around $2.18. So yeah, Matson didn't just beat that number, they absolutely crushed it by almost 34%. On paper, that looks like a home run, right?
And the good news kept coming. Revenue clocked in at over $830 million, just sailing past what the street was predicting. But, and this is a big but, here's our first clue that something's a little off. That huge number, it's actually down 2% from this time last year. And that little year-over-year drop, well, that's where things start to get really interesting.
All right, so you're probably asking the same thing I was. How in the world can earnings be up so much when revenue is actually down? Well, the answer lies in this really sharp split between Matson's different business segments. You could really call this quarter a tale of two very different shipping lanes. I mean, just look at this contrast. It's pretty stark. On one side, you've got Matson's bread-and-butter domestic lanes, Hawaii and Alaska. These are protected by the Jones Act, so they're super reliable, and they showed solid, steady growth. But then you look at the other side, their absolutely crucial China service, and volumes just fell off a cliff. We're talking a drop of almost 15% year over year. Wow.
So what's behind this massive split? Well, according to what management said on the call, the strength in Hawaii is being driven by construction projects and, of course, the ongoing rebuilding in Maui. Alaska, pretty steady economic growth. But the China weakness, that was a different story. They pointed directly to tariff uncertainty. What happened was customers started pulling shipments forward to beat deadlines, and that just created a really lumpy, unpredictable quarter.
Okay, so the big question is, what is Matson doing about all this pressure in what's usually their most profitable lane? Well, they're not just sitting back. They're actually making a pretty significant strategic pivot to reduce their reliance on China.
And this chart right here really shows you that pivot in action. We're looking at something called transshipment. Basically, that's cargo that starts somewhere outside of China but gets routed through Matson's China service. And look at this, it jumped from just 13% of their volume to 21% in a single quarter. A lot of this new growth is coming from expedited services out of places like Vietnam, as you see more and more customers trying to diversify their supply chains.
And this all feeds into the CEO, Matt Topp's big strategy. He's basically doubling down on what makes Matson special, their premium, high-speed service. Because they're the fastest and most reliable, they can charge more than the standard benchmark. That's the SCFI. For the customers, that extra speed and knowing your stuff will get there on time, that's absolutely worth paying for.
So you've got this huge earnings beat, right? You'd think the stock would have just taken off, but nope. It only went up about 1.2%. So why the lukewarm reaction from the market? Well, it all came down to just two little words in the company's guidance for the next quarter. And here they are, meaningfully lower. That's it. Those are the two words that put a damper on everything. Management came out and guided that their Q3 ocean transportation operating income would be meaningfully lower than the roughly $227 million they pulled in during the same quarter last year. Ouch.
And what's kind of crazy is that stark warning completely overshadowed the fact that they actually raised their outlook for the full year. But it doesn't matter. The market is clearly laser-focused on the short-term pain in the China lane. They're bracing for lower freight rates and a pretty quiet peak season for all those holiday goods.
All right, so let's put all these pieces together. What does this mean for Matson going forward? Here's our take. This is the next call.
Okay, so for Q3 results, we fully expect them to reflect that cautious tone from management. All eyes are going to be on two things, China volumes and China freight rates, period. As for the stock price, well, it's underperformed both the S&P 500 and the transport index over the last year. Honestly, we expect it to stay stuck in a pretty tight trading range until we see some real proof that the Trans-Pacific lane is stabilizing.
So that brings us to our rating. We're calling Matson a market perform, and here's the simplest way to think about it. The company's super stable domestic business and their aggressive stock buybacks, that provides a really solid floor for the stock. But all this uncertainty in their high-margin China business, that creates a very real ceiling on how high it can go, at least in the near term.
So, at the end of the day, the big question is whether Matson's pivot can actually happen fast enough to fight off these China headwinds. That's really the story to watch over the next few quarters. Just remember, this is not financial advice.